Well, hi, and welcome to part two of our two-part series, Unleash Cash Flow. I'm your host, Tom Force. Hopefully you've watched part one. We're going to build upon the principles that we learned in that. Deep dive into this. This recording obviously is available, so just take in the high-level view. We're going to get down into some minutia here. Don't be concerned about that. You can always go back and watch it later, but just kind of sit back and get the general ideas that we're going to talk about today. Now, before we dive in, I have to give the obligatory disclaimers, such as there is no such thing as a safe investment, according to the Securities and Exchange Commission. And here's our full disclaimer. Please note that we are not dispensing legal or financial advice. You should have a competent CPA and attorney involved when evaluating any investment. Information shared here is just for conceptual and illustrative purposes. It is simply designed to make you aware of some alternative means of investing for cash flow. We're not offering any property, note, or security for sale or investment, offering anything to buy, sell, or soliciting any investment in any security with this information. The portfolio examples shared in this presentation are simply shown for demonstration purposes and do not guarantee any kind of performance or investment return. All right, so we're back. Now we're going to talk about buying non-performing loans. People do it for a quick profit or property acquisition or both. Now I'm going to use a case study from my friend Jay Redding. He's in Fort Wayne, Indiana. I think this case study has been on Note School TV, but I want to show you an example of how these things work out. So Jay's in Fort Wayne. He knows the market real well. This property's in Fort Wayne, and he found a note that was going into foreclosure on a 3-bedroom, 2-bath, 1,400 square foot home. Here's a summary of the debt. Borrower owed $38,751 when they stopped paying. I'm not sure the reason why. The interest rate was 11%. The loan term initially was 20 years. The monthly payment was $390.34. By the time the note got to Jay's attention, with all the penalties, interests, like I said, once you reach a certain point, the note specifies a default rate, might be 18% or whatever, so it can escalate pretty quickly at what the legal collectible balance would be. So in this case, the legal collectible balance had gotten $85,457. So let's review these deal points real quickly. Jay buys this non-performing loan in August of 2023 for $57,212. It's located in his hometown, so no problem taking it back if he has to turn it into a rental or whatever he wants to do with it. But that's not his goal. He saw it through to foreclosure. The house was valued at $145,000. And when it went to auction, the legal collectible balance was $85,457. The sheriff's sale was set for October of 2023, just 2 months later. So let's look at the math this way. The note cost Jay $57,212. That's what he bought it for. The legal collectible balance was $85,457. That included some legal fees that he put in to get it to foreclosure, but it was 9/10 of the way there when he picked up the note. So it sold at auction. The property sold at auction for $89,000. So Jay's close to 3-month profit, it was about 2.5, was $28,245. Now, let's say that the property didn't sell at auction. Once again, there's the numbers. If it didn't sell at auction, Jay's going to get the house, which is worth $145,000 for $57,212. So he profits either way. He either gets a profit on the note when it sells at auction, when the property sells at auction, or he gets the house back at a substantial discount. So here's a timeline. The foreclosure took 10 months from beginning to end. Lender starts foreclosure in January. Cost is $57,212 to Jay in August, and the foreclosure happened in October at $85,457. Sold the foreclosure, profit $28,245. Not a bad deal. These things happen all the time. You can find these non-performing notes in a lot of places, and hopefully, like I said, don't get bogged down in the particulars. I just want you to understand the concept and decide maybe this is something you might want to look forward to adding to your arsenal going forward. All right, so we have a lot to cover, but that blade of the Swiss Army knife is non-performing loans. It can be a property acquisition strategy, and also there's a way to make some quick money. So here's something I hear all the time. I have no cash to invest. Well, how can you do something with notes? Well, you can flip notes just like you can flip houses. Okay, let's see how that might work out. So, note brokering, flipping. All right, we have a note seller, and you are the broker. We'll call you a note broker. And you don't have to have a license or anything like that to do that generally. And so the note seller contacts you and said, hey, I've got a note to sell. You know anybody who might be interested in buying it? Well, yeah, you know me or you know other people. I'd be interested in looking at it. So you set up the transaction. I'm going to wire money to the note seller. The note seller is going to assign the mortgage to me through a very simple process at title. And for your work, I'm going to send you some money as fee income. Pretty straightforward. It's what people do when they break in the business. You might not have any money, but as you're learning how everything else works, is a great way to make some money. All right, another way. I have no cash to invest. What about your IRA or 401k? So let's talk briefly about tax-advantaged investing. Having invested in real estate for over 35 years now, I'm still kind of shocked when I run into people who don't know that you can use your IRAs, your 401ks, and other accounts to invest in real estate and other investments. I think Wall Street does a really good job of conditioning our society to think that the stock market is it, stocks and bonds, and your advisor gets a fee, and they get fees when they churn the inventory in your account. Makes a lot of money for them, so they want to keep that going. But all you need to do is find one of the many custodians out there that allow what's called alternative investments, and that real estate falls under that umbrella. And there's some rules as to what you can and can't do with the money, but they're very simple to follow. But these are some of the custodians I'm aware of. There's plenty of them out there. I use Heritage. They have the majority of my funds. I'm familiar with IRA Club, and I've dealt with Equity Trust as well. And there's plenty of others out there that will help you navigate the self-directed IRA world. So all of these should look fairly familiar. These are the kinds of accounts you can set up with a custodian to invest in real estate and notes, of course, as well. Forgot to mention before that one cool thing about notes is you can actually own them jointly. My wife and I each have Roth IRAs, and between us we own a note in that. So the servicer takes the payment each month and splits it and sends it to each account. So that's kind of cool. We got SEP IRAs, 401ks, solo 401ks, HSA, the health savings account. I find a lot of people don't even know what that is, but it's the triple play of tax savings, if you will, because the money that goes into it's tax deductible, it grows tax free, and when it's used for medical reimbursements on the way out, there's no tax on that as well. We also can see Coverdell savings accounts, which are used for children's and grandchildren's education, and combined with notes, they can be extremely powerful. And I think this subject is so powerful. In fact, I have the bulk of my note investing in tax advantage funds that I had an expert on, and it's podcast 3. I'd really like you to go back and watch that if you get the opportunity. It was with Derek Long from Quest Trust Company. It was a couple of years ago, but Derek took a really deep dive in all the cool things you can do with notes and combined with tax advantage accounts. Derek has actually moved on from Quest. Quest was recently acquired by Inspira, and Derek has actually taken his expertise and gone and formed Heritage IRA, where I've moved a bunch of my assets now too. So really informative episode, and I think it'll really pay off for you to watch that. So go to noteclubusa.com, go to podcasts, and watch episode 3. In fact, you can watch all the episodes, but I think this will really interest you when you get into tax planning and long-range wealth planning. So moving on, there's a common question that I get. So I have some notes, I need some cash. What can I do? It's a fair question. So your note is an asset. All right, so one thing you do is use it for collateral for a loan. It can be with an individual investor such as myself or a bank. There are companies out there that'll loan, and generally a good quality note with a good pay history, you might be able to get 70-75% of the unpaid legal balance for cash. You can either go reinvest it if you like. That's called hypothecation, and take that money, reinvest it elsewhere, or you may need it for an emergency. But it's far easier than with a piece of real estate. You'll have a check very quickly. Can you imagine trying to do this with your rental properties? you're definitely going to take a haircut. You could sell the mortgage. It is very liquid. It's just paper. We get it out on the marketplace. You can have your money in a matter of days or a couple of weeks. Since you bought it at a discount to begin with, when you sell it, chances are you're not going to take much of a haircut because you've already built in a discount. So you can get back probably as close to what you invested in the note as possible. Just a generalization. Now, the third part is you can sell part of it. And this just raises eyebrows, and this is where we're going to take a deep dive. And I may lose all of you in this next section, but it's very powerful, something you can't do with any other real estate as far as I know. So remember, we talked about cash flow. It was Robert Kiyosaki who said the most important word in the world of money is cash flow. When it's one word, two words, doesn't matter. The second most important word is leverage. All right, so we're going to talk about that now, and this is where we're going to put our banker's hat on. Now, I'm going to talk about the partial. And once again, don't lose yourself in the specifics. Just sit back and get the general idea of how this works, okay? It's one of the greatest wealth building strategies that no one's ever heard of, unless you've seen this presentation today. Now, I like to use the analysis that partials are like pizzas. We consider a note to be the entire pizza. And in this example, you buy it for $12. Now, you have some friends who come in, and they don't want to buy the whole pie, but you sell them a slice each for $4. All right, high-level math here. How much do you have left in the pizza? You have half a pizza left. You sold off $12 worth. You invested $12. You're eating for free. Okay, we can do that with notes. So it's very important to keep in mind that the mortgage is an asset. It's not a security. Okay, and as long as you do partials right, there's nothing wrong with selling off one part of it at a time. Now, if you tried to sell off multiple parts, excuse me, you'd find yourself in a little bit of trouble. But we don't do that. Okay, so I have my asset here in Columbus, Mississippi. And right now I'm planning on collecting 224 payments when I bought the note. We're all good, right? Okay. What if I needed some cash? All right. I could sell off the next set of payments, and I would just have to determine how much that is to meet my needs. So how does that work? Okay, so here's our recapitalizing case study. We're familiar with this note already. Okay, I've kind of beaten it into your head, okay, but I bought a stream of payments, 224 of them, back in October 2022. Okay, 224 payments, I invested that, and I expect that in return, okay? Sitting there just chugging along collecting payments. So this is a snapshot of the servicing statement on that. You can see all the way up through September 14th of 2023 last year. Everything was fine, and it was a perfect note to sell partials on because the borrower pays with regularity. You can see the amount. You know, for some reason it varies a little bit each month. I don't care. It's a little bit over, a little bit under by cents. Doesn't matter to me. And my net amount. The only reason the first one at the bottom is short is because there was a $100 setup fee for the servicer. But anyway, perfect note to sell a partial on because I know their propensity to pay, which is very important, is very, very high. So far, I've collected $14,749.60. Their balance has gone down to $132,529. So out of that $14,749 that I collected, $3,240 is principal, and I've made $11,509 in interest. This is all collected in the first year. All right, so this is a graphical representation after we have been there for 1 year, been in the deal for 1 year. Okay, pretty straightforward. So last September 8th, I had just put my grandkids to bed. I was babysitting, and I opened up Facebook. And in our Note School members private Facebook page, I found somebody who wanted to basically buy a partial, a 3-year partial, wanted to spend about $40,000. The translation on this is someone wants to buy some payments from the front end of a note, which is called a partial, or lend a note holder money in return for an amortized payments schedule secured by a note. Okay, that's what we're talking about there. So that caught my attention because I knew that the note that I had been looking at, the one I just showed you, was a perfect candidate for a partial, and I thought we'd be pretty close to what they were asking to do. So I went in and I looked at pledging the note or selling a partial, and honestly, they can be kind of close to the same thing for our discussions. So what I did is I figured out that's the payment, that $1250.52 is exactly the payment my borrower makes each month. All right. If the partial buyer from my fellow note school member invested $40,500 and I paid them back 7% a year, that would fully amortize over 36 months and it'd be equal to exactly what the payment was. So let's look at where we are. It's a year in. I have $108,410 remaining. We're down to 212 payments because I've already collected a year. So what I did is I arranged with the note school note buyer to buy 36 payments. He pays me $40,500 and I do not get any payments for the next 3 years. But I've pocketed $40,500. I've kept $67,910 invested. I just give up the next 36 months of payments. I still keep 176 payments on the back end. So let's drill down a little bit. What does that look like? Okay. I had $14,749 income year one. Now I took in $40,500. What does this look like at a 36-month pause in payments? Actually, this is happening in year one, but I'm pausing for 36. So I've got $55,249 of my investment back after 1 year. You should recall by now that I paid $111,650. So I've got just about 50% of my money back already, and that money can be reinvested. I'm only into the asset now for $56,401. And when the partial is paid off and the payments revert back to me, I'm still left with 176 payments on the back end. That's $220,000 waiting for me on the back end. So let's look at another way. All right, what if we reinvested the loan, which is what I fully expect to do? So we saw that I sold off 36 months of payments, so I won't be getting that $1250 for 3 years. All right, but I'm going to take that $40,500 and I'm going to reinvest in another note. And based on my rule, I should be able to get $400 a month. And so what I did is I took the income of $400 a month over 212 payments, just like I originally had with the other note above at 212 payments. Okay. Probably get more than 212 payments, but anyway, that's good enough for this example. So my one note became 2 notes. I've still only invested $111,650. Okay, now that's the cost for 2 notes. The second note from the $40,500 loan invested for 212 months cash flow will be $84,800 returned. Plus, I've got the original $220,000 from the original note. Once I get it back, original cash flow from year 4 on, plus the $14,750 from year 1. Now I'm looking at a total return of $319,550. As you recall before, it was going to be $280,000 before I sold the partial. So this is the power of leverage. I invested $111,650. I was fine with my one note. I had planned to get $280. But now I'm getting $319,550 because I took some more money up front, put it to work, and I get $39,550 extra. So let's look at the players here. Okay, the guy on the bottom, he's my partial note investor. He's the guy who bought 36 payments for $40,500. What's in it for him? Well, he's going to get a hands-off 7% return, fully amortized, secured by real property. This is the guy who had his $40,500, not saying this particular person, but in general, part of that $6.5 trillion that's sitting on the sidelines looking for something to do. Happy as heck to have a 7% return that hits his mailbox every month. Okay? He's got a low investment to the balance, So he's protected in case there's any default, which I'm actually, that's me. I'm not in drag, but the note seller, I try to represent both sexes here. The original investor is highly motivated to see that the note continues to perform and remains a partner in the deal, because all that blue still belongs to me. So I want to make sure nothing happens to this note, and if it does, I work it out. And if that were to happen, I still have the money bomb there, and also my investor is going to be fully paid off with whatever's owed to him at the time. All right, now the advantage to me as the note owner on the back end, okay, gave me that $40,500 to reinvest and increase my velocity of money and my returns. I have a large back end for a lower investment. In other words, when all that's paid off, I still have that $220,000 left of blue in there. Okay, right there. I also have the potential early payoff bonus, which can happen at any time. You see that spread goes on for a long time. Even when the partial's in effect, I still stand to collect from that, and I would just pay the partial investor off. All right. Oh, and did I mention that's outsourced? All I'm doing basically is filling out a little paperwork with the servicer and redirecting the payments to my partner for 36 months. And then when that 36 months is over, the payments come back to me. Hands off. I'm not having to send them payments or anything. I just don't get anything for 3 years. And the servicer takes care of that. Most servicers are set up to handle partials. All right, so let's just say this was such a great deal, okay, that my borrower wants to do it a couple more times. Just a theoretical here, because I want to give you an example that's going to knock your socks off. Let's say we did this 2 more times. So after the 3-year partial is up, he wants to buy another, and then buy another. All right, could happen. All right, at that point, I would have 90,078 as far as what the borrower still owes. I'd still be into it for 79,961. So there is a little bit of a money bomb there. Well, recall I had my income from year 1. Now I've taken in $121,500 worth of income in just 9 years. That's, well, actually, yeah, it's the start of the 7th year. I'm just showing it a 9-year pause before I get the payments coming again. It's a 9-year pause on payments. So I have $136,249 back after 7 years. Now, it's not high-level math, but I'm sure some of you are thinking, well, I only put $111,650 in. Yes, I am into the asset for negative money. In other words, I've gotten almost $25,000 back. I have nothing in it. I have nothing at risk. And when I get it back at year 10, I still have 104 payments of totaling $130,000. You talk about growing wealth, that you can't beat it. You cannot compute yield on something like that. Hopefully that's something you find interesting. If we were doing this on a Zoom call, I would be hoping that I'd see that look on your face right about now. It's all real. That's exactly how notes work when you sell partials, and there's no rules as to how you work it out as far as the numbers. I'm going to show you another example here that'll make some sense as well. Let's talk about the Coverdell Education Account. It's set up to be a tax-free account for growing money for education, generally higher education, although it can be used for a private school or a whole bunch of different things, not just college. The limit on the investment is $2,000 a year, and it has to be done by certain people, parents or whomever, and that's the limit. So you can set that up, let it grow. Most people put it in some sort of savings account, and it accrues, a few pennies here or there. But when you have it in a trustee like Quest or somebody else, you can actually invest in notes. I have a picture up there, Martha Speed. This is Eddie's wife. She is probably the best person in the world for doing what we're about to show. I think she invented it. But she is the chief architect of the Coverdell Educational Partial example, which I'm going to show you right now. So there's our same note. We should know it by heart by now, okay? And Martha wants to find a way to get this into her grandson's Coverdell account. All right, but he only has $2,000. The note costs $111,650. All right, hang with me. Through her relationships, Martha, say it 3 times fast, Martha knows passive investors who want to invest. And just like the gentleman who invested at 7% in my deal, okay? He's got $110,000 sitting on the sideline doing nothing, having termites eat away at his nest egg. So Martha says, hey, I've got a note coming along. It's a 20-something year note. I can pay you 7% on it. And, how much would you be interested in investing? And he goes, oh, about 110,000 is what I have. So the way we're going to structure this is the passive investor is going to come in with $110,000. The Coverdell account is going to come in with $1,650. All right, let's see how this plays out. So Martha has to decide how many payments will she transfer to the passive investor for his $110,000. All right, we're looking to figure out how much of that is going to go up front. So we have a simple Excel calculator that will tell us that, well, to give the passive investor 7% return and a little bit of change, we'll round up and it'll be 124 payments that the passive investor is going to buy, leaving 100 payments for the grandson's Coverdell account. Now keep in mind that the passive investor is bringing in $110,000 and the Coverdell account's only supplying $1,650. So the transaction's set up with the servicer so that the passive investor gets the first 124 payments. He gets $155,000. And then after that 10 plus years or so, a little over 10 years, then the payments revert to the grandson's Coverdell account. And over the next 100, he'll collect the next 100 payments for a total of $125,000. And so that's what it looks like. So to reiterate, the passive investor kicks in $110,000 of the note cost, gets his 7% for 124 payments. The Coverdell account is out $1,650 and is deferring any income until month 125. So the passive investor, $110,000 at 7%, 124 months, collects 124 payments at $1,250. He's first to be paid if there's a workout situation, so he's in a very strong position. Martha has a vested interest in the note. She wants to make sure that it goes through all the way through to fruition, so she's going to keep an eye on it, and if there's any workout situation to be done, she'll be on top of it. The passive investor truly has nothing to do in this example. The Coverdell account took $1,650, leaving $350 behind. It defers income for 124 months. And starting in just over 10 years, the account collects 100 payments of $1,250. At the end of this mortgage, he will have collected $125,000 on an investment of $1,650. It's magic math, but it's real. So let's say that Martha found 5 of these, theoretically. All right? Starts at age 1, age 2, $1,650 on each of them. She could be investing as little as $100, and we'll show an example there that in a second. All right, those 5 notes, if they went to full term, will be paying off $625,000 for an $8,250 investment. Now, of course, there's all sorts of permutations. This is just an example of what can be done. Okay, so we've got the investor and we've got the Coverdell. Now, let's say in this particular investment, as soon as the investor is out at 124 months, the loan pays off. All right, and there's a money bomb of $87,126 on this, payout that goes into the Coverdell account. It's not a bad thing. All right, so let's play what if again. All right, let's say that once the investor is cashed out at 124 months, the loan pays off, and $87,126 goes into the Coverdell account, and it grows at 5% till the child's 20 years old and in college. All right. They will have netted $135,161 on the one that was bought when it was a year old. So let's go ahead and take this through naturally. If there were 10 notes bought 1 year at a time and they all paid off in that manner, it'd be over $1 million worth of education money, tax-free, for a $16,500 investment. Now, it just shows an example of what can happen We get example, one of the things we're questioned about by rental owners is what about amortization, appreciation, things like that. Well, the leverage you can get in notes, I'm just demonstrating what can happen and what does happen quite frequently when you know how all of this works. What about how to retire tax-free forever? All right, this is another one of Martha's special. All right, so here's a sample deal. Let me go ahead and get the players involved. I'm not very good with these PowerPoint animations. We got everybody here. Just about. Okay, so Martha wants to buy a note for her self-directed retirement account. It's $105,000, but she only wants to pay $100 for the back end, for the partial, or the partial remainder after the first part is sold off. She has a passive investor, and that passive investor is going to pay her $104,900 for that area circled in or marked off in blue on the full note. She's going to add $100 to that stack and send $105,000 to the note seller. All right, the note seller is now paid the entire balance of the note. The note now belongs to Martha. She assigns the first number of payments to the passive investor. Whatever they worked out to be, she keeps the rest. So for $100, she has all of those back payments on there. I don't care how many they are. I think you agree for $100 in a Roth account, you do that as many times as you possibly could. Now, like I said, suspend your disbelief. It's how it works, and you'll learn how to do all this when you dive into notes and get around those of us who know how this works, or get training from Eddie. This is one of the cores of what they teach, is how to use leverage like this. All right, so that's another part of the Swiss Army knife, is the partial and using other people's money. So let's press on into the final stretch here with seller financing. So buyers are getting home loans from an unlikely source, the seller of their house. So what we're finding is seller financing fills the void that conventional financing cannot serve. And right now, lending standards are very, very tough. In fact, Eddie wrote a 3-page paper on this. Is it crazy to seller finance your rentals or crazy not to? And his hypothesis, which he goes ahead and proves in this paper, is that generally you can cash flow 3 times by selling your home on seller financing, or selling your rental, than actually having it as a rental itself. And actually you can download this particular document on my website. Just go to noclubusa.com/SF, like seller finance, and you can read it. Now, when we talk about seller financing, a lot of people think about the Alabama condo. If you're from Alabama, then this is Louisiana. Don't mean any offense, especially the guy there with the lakefront view on the bottom there. So anyway, no, we're talking about some really good properties. These are some properties that I could have bought with seller financing through my connections at Colonial over the years. A vacation house in Maine. We could have had raw land in Spring Branch, Texas, and a condo in Honolulu. So it's not all junk. Okay. So why now is everybody turning and looking to seller financing? Why is it suddenly opening everybody's eyes and say, yeah, I gotta know how this works? Okay, interest rates are up. Traditional mortgage availability is down. Inflation and other economic issues may force some property owners to sell out of necessity. They can't maintain their property. They can't stay in it anymore. But the flood of buyers to their door has dried up, so they may have to become the bank in order to sell their property. Aging baby boomer landlords want to start cashing out in the face of a tough market. There's tax advantages that we'll talk about. And record levels of investor capital to support these transactions is sitting on the sidelines looking for something to do. We talked about that $6.5 trillion. These are current mortgage rates from a little while back. Look at the part at the bottom there. You need an 800 credit score, 20% down payment, and a better than 35% DTI ratio. Very few people these days are going to qualify. This is the Mortgage Credit Availability Index from the Mortgage Bankers Association. Back in the halcyon days of 2019, just about everybody could get a mortgage again. It was 189. Now we're half of that, literally half of that in August 2024. We have a lot of good people out there with money on the sidelines. They've got money for a down payment, but because those lending standards are so high, they're kind of priced out of the market. So this is where seller financing comes in. Let's look at how big this market is. This is from my friends over at Node Investing Tools, and they give me permission to share these slides. So you can see in 2023, it was a $28 billion market. You can see it's on the rise again. 2022 is a funky year, but it's kind of on the rise again. $28 billion in volume, 89,773 filing count in 2023. All right, by property type, residential makes up 50% of the net value and 63% of the number of transactions. Commercial is about 17% of the transactions, 33% of the financial value. Land is down there at 16% of the transactions, and the unknown or unrecorded is down there at 4%. This gives you a good idea of where we've been in the last 5 years. You can see when mortgage rates were low in 2020, not much use for it, but now we've almost doubled the volume to $14 billion just in the residential alone. You'll see how the breakdown is for the average note for residential. It's about $250,000, 10% increase. It's about 74% loan to value. Commercial 613, and land notes average about $264,000. Everything's on the increase. Notes are getting bigger. States where seller financing is most popular: Texas, number one by far, 25%. People ask why. Well, land is popular. We have a lot of land out here. But also the demographics of the south half of the state lead to a lot of seller financing transactions, and they're really good transactions. I do buy some notes down there, and I'll buy those all day. So you can see some of the other top states here. Where's the second? Florida's the second most with 9.2%. And you can see Texas leads with the number of notes created. That's how many in 2023 that we know of. This is important to know going forward. 86% of the notes were created by somebody who only created one note in 12 months. Generally, we're talking about somebody selling their rental property, a mom and pop, we call that. 14% of the professional note creators doing 2 or more. That's just a little slide graph to show the same thing. The mom and pop created notes are, like I said, up there around 86%, and they're just going to increase as we move forward in the coming years. All right, we have by entity type, corporate entity, which could be, somebody has it in their own little LLC that they created, okay? The trusts are 11%, and then the individual, like I said, many of the individuals are using the LLC, but the individual who owns it in their own name is about 57%. All right, so this is our avatar, the burned out landlord. We've already talked about all his issues. He wants out. It's become a grind and a cash suck. Taxes, insurance, repairs. How about a new AC unit? It all adds up. So his problem is lowball offers, few traditional buyers, and possibly capital gains taxes. What's he going to do? Well, when I first did this presentation, I went to some software and I pulled up just in the 4 counties around me, and these numbers have probably increased since then. We're looking for absentee owners who are free and clear and owned in a name, not a business. Okay, this doesn't even include the LLCs. So in Dallas County, we had over 75,000 of these potential burnout landlords. All right, Collin County, just north of Dallas, we had 32,000 and change. All right, Denton County, north of Fort Worth, we had over 10,000. And then Tarrant County, where Fort Worth is at, 42,189. So that's almost 160,000 leads in just 4 local counties. All right. Saw this pop up on a Facebook feed. Said, I'm so over being a long-term landlord with long-distance property management. So even when you have a property manager, this can be difficult. So agents and investors, are you happy with one tool, or you want a whole tool belt in your pocket that Notes can give you? You're going to solve homeowner problems and get paid. So What's the first thing we run into when we're out there? The seller's stuck on price. You're trying to list the property, the seller won't budge, you're trying to buy it as an investor. How many times have you been through this? You want to list the property for 250, the seller wants to list for 300, or you're trying to buy it from them, you're going to lowball them at 250 to make your numbers work, and they say no. Well, what if you had the tool of terms in your pocket? So let's see how this works. So let's talk about whether price really matters or not. Okay, follow along with me here. Say we have a seller who wants to sell his property for $270,000, and it might be worth anywhere from 250 to 270, whatever, but he's not going to budge off of 270. Okay. Now your buyer's budget, if you're getting money with the bank, your buyer's budget is only $1,000 a month. So with bank financing at 6% for 30 years, he can only entertain a property that's $166,800. But what about some private financing? The seller holds the financing. Now that $1,000 a month at 2% for 30 years generates $271,000. Now the seller is still going to get his price. All right. It's just going to take longer to get paid off. So let's look at this another way. House is $100,000. We've seen some of those in our examples. You pay $100,000 cash for it, or I could pay $10,000 a year for 10 years, or I could pay $5,000 a year for $20,000. You see, it doesn't matter what you pay, it's when you pay it. All right. One entity out there that's really figured that out is the furniture companies, the Rooms to Go and Nebraska Furniture Marts. Yeah, they're going to finance everything for you. Rather than take the money up front, they know you'll spend more, and most likely after the 0% 2 years is up or whatever it is, that you'll start paying, and they'll make a lot of money on the financing. Okay, so if it's good enough for the furniture companies, should be good enough for your seller. And we'll dig into a few more reasons why, but just want to give you that analogy that the furniture companies know what they're doing, and this concept applies directly to being the bank on a real estate transaction as well. So let's talk about this. His problem number one is lowball offers. Solution is a reasonable full price offer on terms. So if you're knowledgeable about notes and know how to bring value to the customer in a seller finance environment, you could suggest, if you're getting nowhere with a listing appointment, we might be able to find someone who could give you your asking price if you might in turn be flexible on the terms. Is that something that might interest you? Now, why does this work? Well, the seller is going to get a cash down payment from the buyer. It's not set as the amount, and we'll show some examples of that, but they're going to get a chunk of money up front, all right? And the rest of the terms will be dictated from what their needs are. They're also going to receive a monthly predictable cash flow, which is kind of what they were looking for with their rental to begin with. Plus, now you've opened up the buyer pool to the non-QM buyers, the people who can't qualify because they don't have the 800 credit score, you know, and the perfect credit and the low DTI. Okay, so who are some of these people? Well, they're self-employed people. Those of you who are real estate agents know how this goes, the little dance that you do between the IRS and the mortgage company. You're perfectly capable of buying a house, but a lot of times it's difficult to get a loan. We have gig workers these days, the Uber drivers, I-10 buyers, individual taxpayer identification number borrowers. These are the folks who don't have a social security number, but they have good paying jobs, and they want to buy a house. It's sacred to them, and they'll do anything to make their payment. They just want to get in. And then the folks with less than perfect credit who've had hiccups. We've all been there. There might be an unknown 30-day late on your credit, and you didn't know about it till you went to apply for a mortgage, and it hit you like 70 points. The credit score stuff is really difficult to work with. But when you're in this environment, that's not something we necessarily have to worry about. Once again, the mortgage credit availability, that giant circle right there, you know, that's your That's your target right there. There's a whole bunch of people sitting there wanting to buy homes who can't get loans from the banks, and you can be the answer. So let's talk about this. How does this work for me or for you? Okay, let's say you're a real estate agent. Okay, you can get more listings from your leads through seller financing. I know that here in Texas, less than 5% of the listings offer seller financing. And not everybody can, but and even if they do have an underlying mortgage, there is a way to work that out. I'm not going to get into sub-twos here. It's called a subject to transaction. Not going to do it here today, but if that's something that interests you, we have all sorts of resources that will show you how to do it. It's actually very legal here in Texas, and I'll show you the reference here shortly. But what I'm talking about is just taking our friend here who wants $300,000 and she wanted to list for $250,000, and we'll say, okay, would you be willing to entertain seller financing? You're going to open up, more opportunities to list and to get buyers and get completed transactions. So how might this look from the seller side? All right, so he's going to sell the house. It should say sales price, but he's going to sell the house for $300,000. This is the guy who wanted to list for $300,000. It's going to be sold for $300,000. The down payment, he's going to look for 20%, so he's going to get $60,000 right up front, cash in his pocket. And then he's going to go ahead and finance $240,000. Now, he could do that at 8% and over 20 years. He can just pick the figures. It's his chalk and his chalkboard is what we say. All right, that would work out to a payment, principal and interest, of $2,007 a month. Okay, now, well, let's say that he comes across a potential buyer, who can only afford, say, $1,750 a month. Well, they could recast this from 8% to 6% and change the payment, maybe put a balloon at 10 years. There's a whole bunch of different ways that we can construct this seller financing to meet the needs of both the seller and the buyer. Now, for the seller simply becomes the bank. No taxes, insurance, repairs, etc. Just a check from the servicer each month, and this process is handled through the servicer. Okay, the buyer is not sending a check to the seller. We handle it through a servicer. Okay, it's all done professionally. It's the way we do it. We also qualify the buyer through an RMLO, which I'll get to in a minute. If the buyer does not pay as agreed, the seller forecloses, takes the property back, keeps all of the proceeds that have come. So that $60,000 and any payments up until then are all in his pocket, and he can rinse and recycle. Certainly has a lot more in his pocket than if he was renting the property out and a tenant came in and reneged on the lease agreement and he has a bunch of repairs. At least the seller this time has a lot more money in his pocket, and that's one of the key differences here when you start looking at seller financing, why it's different. All right, let's say you're an agent. You can negotiate the terms for your buyer client's seller finance purchase, or you say that you're an investor. Okay, so how does that work? Here's something off of one of the local Facebook pages. Have a client needing seller financing, he can do 30% down. Looking in Dallas, north of 30, 200 to 350K range, prefers single family, but open to other options. Please direct me if you have a fit. Okay, well, if you're this person's agent, you can negotiate the sale of the terms of the sale on that person's behalf. Okay, so one of the things we're going to look at, and this is just high level right here. This is all 30,000 foot view. This is the minutia that you can learn to do this effectively and profitably with the proper training and experience. Just trying to show you what's possible. So you're going to make sure that the loan is SAFE Act compliant. We're going to get a residential mortgage loan originator in there, and that person's basically going to make sure that all the income verification and everything else is in order, the employment, the finances, pull credit, to make sure that the buyer is going to be able to pay the principal, interest, taxes, and insurance. We're not just going to take the first person who calls us off of Craigslist. There's going to be a process to do this. Because if you don't qualify the borrower and you just take the first person that comes along, you could be liable for predatory lending practices if that person defaults. We don't want that, okay? Just as in everything in life, there's a right way and a wrong way to do things. We want to show you the right way to do it. All right, these loans will be third-party serviced and closed at a title company. Those are some of the All right, so let's look at that same transaction with a little bit more favorable terms for the buyer. Okay, remember, this is a canvas and it can be drawn on. We will agree to your asking price if you can be a bit more flexible in your terms for my buyer. And just as a point of reference, on the $300,000, a bank loan at 7% for 30 years, 20% down, it's going to be $1,860 a month, and the total payment over the 30 years is going to be $729,000. So now instead of 20% down, we're going to offer 10% down. Still 30%, it's still 10%, $30,000, still money that goes to the seller at closing. We're going to finance $270,000. Now these are the terms. And like I said, this is a blank canvas, but this is what you could draw up. All right, we're going to finance $270,000 at 2%, $998 payment for 5 years. All right, on a 30-year AM. So we're going to amortize a loan over 30 years, and then for the first 5 years, we're going to pay at that rate. Then that leaves $235,000. We'll step up to 4%. The payment will increase a little bit more, 5 years, and then we'll have amortized that at 25 years. And then the rest we'll do 205 at 6%, 1469 for 20 years, and then I'll cash them out to the 30-year point. Now, the borrower only pays out $516,000, $516,840. The seller still got us $300,000. The borrower comes out way ahead of the bank, which he probably would not have qualified for anyway. This is called a step rate. We do this all the time. It's just something that, is part of our business, and it's probably worth learning. So anyway, just another one of those what can be done type transactions. A knowledge of seller financing. You might just want to use them to go out to buy your own properties, for a personal residence, a vacation home, investment property, or something commercial. I've got a personal example of this. My case study for Little Rocky Lodge that I bought back in 2005 with a partner. It was for sale for $500,000, and the property was worth it, but the annual revenue was only $40,000. We knew we were going to increase that revenue quite substantially, so we were willing to go forward. No banks are going to be lending on that kind of income, so creative financing came to the rescue. So what did that look like? So we started at the bottom. Both my partner and I put in $25,000, so we only put 5% down each of us. We had a private investor who came in at $50,000, and we paid him out pretty quickly. Then the seller agreed to carry a 15-year note at 7% for the other $400,000, and we just paid him out of the proceeds from the business. And we paid that off in May of 2020, just in time for COVID, but we managed to survive that as well. It was an interesting time. Finally, you and a partner can buy a property on seller financing and then sell it on seller financing to an investor or non-QM buyer for cash flow. I've got a case study to wrap this presentation up with, but first let me talk about something else and we'll wrap up with that case study. Unfortunately, taxes are also something that our experienced landlords have to deal with. If they have, fully paid off properties, when they go to sell, they actually have to pay a whole bunch of taxes. Investment property taxation. Now, I'm not talking about, when you sell your residence and you get the exclusion up to $500,000 if you're married, if you've been using the property as your personal residence for 2 of the last 5 years. I'm talking about straight investment property taxation. You could owe capital gains. There's a depreciation recapture. There's an affordable care surcharge in there. If you live in a state that taxes you, you could get stuck, and you might only keep about 38% if you're in one of those states. Let's talk about 2 in particular that you're going to have to pay at closing. It's the federal gains, capital gains tax, and the unrecaptured Section 1250 gain. It's basically clawing back all the depreciation you took. All right, now I'm not going to spend a lot of time on an example, but what I want to show you is publication 537 of the IRS. And the key to this slide is if you sell the property on an installment sales agreement, which is what seller financing is, you can report the capital gains on the gains as you receive them. So if you sell your property and you agree to sell it for, let's say, 30 years, just like a regular loan, all right, and that income comes in, you're only taxed on the capital gains as you receive them. And as you spread them out, you're going to be paying those taxes with tomorrow's dollars, which will be worth much less. All right, since your burnout landlord is going to be paying this over time, they may end up paying no capital gains tax at all. In fact, in 2024, if their adjusted gross income, if they're married filing jointly, is less than $89,250, they pay 0% on that capital gain. And once again, I'm not trying to make you a tax expert. All I want you to do is just take a look at some numbers here. For a couple filing jointly, if their income is $116,950, they're going to get the standard deduction $27,700. So if they fall below that threshold, any income that was capital gains is going to be taxed at 0%. And once again, I'm not trying to make you an expert in this stuff right here. All you'll want to do is make your seller aware that this might be something that could happen, especially if you're looking to buy it yourself as an investor. But you want them to validate all of this with his or her CPA. Chances are they have no idea. They're sitting there with a tax problem, didn't know that it could be mitigated through seller financing. It'll be often eye-opening for the seller, and it gives you an opportunity to continue down a path of sale that you may not have had a chance to make otherwise. Okay? So we might have Mr. or Mrs. expired listing. Just curious, has anybody provided you with a tax strategy offer, giving you a fair price and possibly a large tax savings? Would that interest you? Okay. All right, well, if you haven't gotten this phase so far, I think my last case study as I wrap up this presentation is going to do that for you. So here we go. It's my buddy Homero Corona. He's a real estate agent here in the Dallas area, also very fluent in notes and does a lot of note business. I want to show you one of his case studies that I think is a great way to wrap up. So he's dealing with a property in Whitewright, Texas, just northwest of the Dallas area, about 45 minutes. He found out about this through one of his contacts. So the initial deal points. So the seller's father was a real estate investor, and the seller that Homero is going to work with inherited 65 acres of land. Now that seller immediately, the person who inherited the land sold 40 acres for cash. All right, the seller spent the money on quote unquote a few things and now is out of cash. Now he wants to sell more of the land. This is where Homero comes in. He was connected by a contact that knew both parties. And Homero asks if they would like to receive a monthly payment, and the wife said yes. Apparently she knew that the money was being burned through real quickly. Okay. So let's look at Homero's buy. All right, they agree on $289,656. This is 17 acres at $17,000 plus some closing costs. It's the same per acre cost as when they sold the 40 and blew the money. They talked about a down payment, and Homero asked them, well, what kind of money down do you want? And they said, well, we could really use $25,000. So we said, okay, we'll make it $25,000. So the seller is going to finance the rest at $264,656. All right. So the wife wants the $1,200 a month. And Homero's math is, well, we're going to take the sale price, or actually the finance, divide it by 1,200, and that's going to come out to 221 months. Now, there was never a discussion of an interest rate. So he presents that to the family, and the wife says, well, that's kind of long. How about we do 12 years? And he says, okay, 12 years. We'll do $1,200 a month for 12 years, and then a balloon payment of $92,210. They both agree that's a good deal. So this is what we call a private first mortgage. All right, these are all the terms. Homero is going to make 144 payments of $1,200 and have a balloon at the end where he's going to owe $92,210. But he probably won't. We'll talk about that in a second. By the way, if he tried to buy this through a bank, which he probably wouldn't have done because it might not have worked, he would have had to do about 25% down, put all that money down, and a 9.9% for 20 years would have been $2,082 a month. So a good deal for him, and the seller is getting a good deal as well because they're getting some cash. But Homero has no interest in hanging onto the property. He doesn't want to do anything with it. So he's going to sell it on what's called a wrap transaction, where we're going to take the private loan and we're going to wrap it with another mortgage from the buyer. Those of you in Texas are going to tell me, oh, this is illegal. Texas Senate Bill 43, effective January 2022, outlines how we do that. So get out Google and you guys can see what's required to do a wrap. Okay. Okay, so Homero has a buyer who wants to buy the property. and he finds him before the closing even takes place. So we're going to do a simultaneous close. So the sales price is going to be 426,438. Now this is 17 acres at 25,000 an acre plus some closing cost. Now the down payment was negotiated. The buyer asked Homero what he wanted down and what his terms were, and he said, "Well, I'd like $75,000 down, and I'd like to do 10%." Buyer goes, "What if I gave you $100,000 down and we did 9%?" He says, "Okay, that's a deal. We're not going to split hairs here." So Homero's going to pocket $100,000 minus what he owes, and I'll show you that in a second. He's going to finance $326,438. So the wrap note: Homero is going to be taking in $4,135 a month, earning 9% for 10 years. So that's what it looks like, 120 payments for 10 years. So at closing, the seller is going to close first and the buyer is going to come along. At the end, Homero is going to walk away with a check for $75,000 just for playing matchmaker. All right, so let's look at his 10 years of wrap income. Monthly income is going to be $4,135. His monthly outgo is $1,200. He's going to net $2,935 a month. So we play that out over the 10 years. He's going to make $110,000 the first year, including the closing. He's going to make $35,000 and change all those years through 10, and then he's going to have some negative issues on the end because you probably caught on to the fact that he still owes for the balloon. All right, so let's talk about that 12-year balloon. On the face of it, it doesn't seem like a big deal. He's going to make almost $370,000 in 10 years. He has a balloon sitting out there at 12, plus those short payments in year 10 or 11. I don't think that's going to be a problem. I'd take this deal all day, just the way it's structured. But wait, there's more. Of course there is. And this is the beauty behind these deals, especially when folks start getting separated from the mailbox, we call it. So the rest of the story, as Homero tells it, is that he's at the title company waiting for the second closing to happen for the borrower, the new borrower, to pay. And the first borrower is like, "Hey man, I really need that $25,000. Where is it?" And Homero's like, "Oh, don't worry, you're going to have it this afternoon." And he sensed that these folks just burn through money, that they're going to need more money. So as a seasoned note investor, he knows this is what's going to happen. Not too far down the road, might be less than a year, the land seller is going to say, "Hey, can you advance us some of their payments that you owe us?" And Homero sure is going to say, "Well, how many you want to buy?" And they're going to work out a deal. And Homero might pay $10,000 for a year's worth of payments that would be worth $14,400. And it's going to happen again. It's going to happen again. And eventually, somewhere down this timeline, that balloon payment's going to come into view. And Homero's going to say, "You know what? Why don't we just be done with it? I'm going to write you a check for XX, and we'll call it done." And they're going to say, "Yeah, that sounds like a good deal." And Homero will have paid a lot less than what he was contracted to do to begin with because they kept wanting advances on the funds. That's why the balloon payment is probably not going to be a problem because it's going to go away probably before Homero's income goes away as well. So anyway, just thought I'd share that example with you with another live person who shared this on Note School TV and elsewhere. These are the kind of things. This is making money out of thin air if you know how to do this business. All right, so we filled in all the blades there with seller financing and also some tax avoidance. So what do we cover in our session today? We discussed what a note is, how to become the bank, owning notes for cash flow versus rentals, what to do when notes go bad, how to use non-performing notes to get properties at a discount, using other people's money, using tax advantage funds, the magic wealth creation of the partial. That was gold all by itself. All right, why seller financing is suddenly so relevant in this market. Why having the seller finance a transaction broadens the buyer pool and makes price irrelevant. Talking about potentially huge tax savings for sellers using the installment sale method that they probably have no idea about. And questions you can ask a lead to potentially create a deal where it otherwise was not going to happen. And yes, this is also a look I was going for today. Hopefully I was successful. So if you've hung in there with me for a total of about 2 hours and 15 minutes through 2 videos, I've got to believe there's at least some path in note investing that's right for you, that you're interested in, whether it's just buying cash payment streams like I did, buying non-performing loans to try to get properties or a quick profit, brokering notes, learning more about seller financing. There's a world of opportunity there, and I'm sure that there's a blade or two on that Swiss Army knife that you're interested in. One of my sons runs a real estate team, and he brought this quote to my attention. Said there's a 70-year-old version of yourself looking back, hoping you're doing the right things today. Now, I'm not quite to 70, but there's a lot of wisdom there. All the things you do with your money early on, you have the opportunity to grow exponentially, and now is the best time to be learning strategies such as note investing. All right, so I'm not a psychic. I don't play one on TV or in webinars, but I do figure that this is the question that's on everybody's mind. How do I learn more? Now, I've given you everything I've got in 2 hours and 15 minutes worth of information. I've got my website where you've got access to my book for free. We've got podcasts and other resources. So I'm tapped out onto what I can do for you. But actually, all I've done is prep you for the main course, and that would be studying with my mentor, Eddie Speed. Now, after all the video training that I've given you, the only next logical step is to take that and ramp it up to the next level. And you do that with 2 days with my mentor, Eddie Speed, and the staff from Note School. At the time of this recording, they do it once a month. It's here in Dallas, but you can also tune in virtually. It's a deep dive. If you take the knowledge that we have here and you come into these classes prepared, they're going to take it to the next level. It's exactly what I did. It's been a godsend for me. They keep the classes fairly small. They have a lot of individual attention. But let me play a video from Eddie on the next slide that will show you exactly what's all involved.
Rich rewards in notes. And that class is an experience. Why? Because in that class, we don't just do education. We actually take case studies, live transactions that have closed, and we show what happened and we show what else could have happened. We do it with students' transactions and we do it with our transactions. We're able to reconstruct the process that was thought as it went through in the case study. We'll show you deals that worked well. We'll show you some deals that even didn't work well. We'll show you rescue strategies. We'll show you phenomenal strategies in all different areas in the business. So the most important single thing you can expect when you come to the class is not just what we're going to teach, but how we're going to teach it. This class is an experience, and we want this experience to change your life. What we want to do in this class is take all aspects of the note business. Now that can be where it affects a real estate investor, where they're buying properties and need a creative financing strategy to buy a property other than just at a wholesale discount price, how they may resell a property with seller financing. We're going to show you how to buy existing notes that are paying. Those notes could be notes that you earn long-term income with. You could do a leveraging strategy with your company or your retirement account, or you can just earn fee income and flip the note to somebody else. We're also going to talk about how to buy a loan that isn't paying, a non-performing loan. All of these different strategies are things that we're going to discuss. We'll call them success paths because these notes bring long-term success to people in the business, and we're going to show you the path that people follow to experience the greatest success. So we're here at my desk. What we're going to be able to do in this class is duplicate what we do here in our shop every day. We're going to show you how students do it virtually all across the country. They don't have to have an office like mine, or they can have an office like mine. They can do it in conjunction with the business they're doing right now super successfully. And how are we going to show you this? We're going to show you via success paths. What's a success path? This is a proven track record of how to do it successfully. We're going to show you case studies and step-by-step processes of how someone went through to have the ultimate success in their transaction. Success paths are the proven track record, and case studies are the easiest way to remember it. And so you're going to see a consistent pattern of us doing this. We're going to show you creative financing, buying property, selling property, buying someone else's notes, creating wealth with it, either in your personal investments or your retirement accounts. We're going to also show you strategies of fee income. All these things are things that we're going to be able to beat up over and over and over, and we're going to do it with the experience of case studies. Whether that's long-term income, short-term upfront income, whatever that scenario may be, we're going to be able to show you different ways to accomplish what you're trying to accomplish. Experience that people have of being there live, and the engagement and the energy in that room is dynamic, and it's dynamic to me every time we do it. I love being there. I love getting to know you guys, and I'm excited about your coming to see us at a Rich Rewards class and learning the strategies that are going to change your life.
I can tell you those trainings are the real deal. I actually come down to the ones in Dallas, and I usually talk for about 10 or 15 minutes and meet with potential note investors to answer questions. It's just a good time, and it's jam-packed for information. It's different than any kind of training you've been to before. Really get a deep dive into all aspects of note investing, and the feedback has been tremendous. You can go to the bottom, noteclubusa.com/start. You can go ahead and go to the enrollment page, scroll through the entire page, and read about all that's involved in the training. I think you'll be blown away by the value. And then as part of the Note Club USA tribe, you're going to get 50% off. So when you go ahead to enroll, which most of you are going to want to do, when you click the enrollment form, put the promo code START in there and you'll get 50% off. It's our gift to you for being part of our tribe. You know, one kind of cool thing about the note investing community is we're fairly small. We're a great community. I love the people in it. But we still have a fairly small community compared to the other types of real estate investing out there. So I'd like your help in growing it. If you found this content valuable and you think you have people who might be interested, go ahead and send them to my website, noteclubusa.com. You'll see that I'm not selling anything there. My book is free. They can check that out online. The podcasts, all the information we have on there is free. And then if they like what they see, send them to the noteclubusa.com/unleash. That's part 1 of the video series, and help them get the opportunity that you're enjoying now of an alternative path to financial freedom. I'd really appreciate it, and they probably will as well. If you need a speaker for your office or event, go ahead and hit me up. I can do this presentation. I can do a much shorter version, just the basics in under an hour. I can do it for your team via Zoom. We can set it up via webinar. I've got StreamYard, whatever you need. I like to do it in person here in Dallas, but I'm happy to travel wherever the need be. All right, so that wraps up the presentation, but keep this in mind. They say the best time to plant a tree was 20 years ago, maybe 30 years ago. The next best time is right now. And so I was 62 when I found out about notes. I missed out on a whole lot of opportunity to get compounding gains. So you're in the right place at the right time. You probably have a lot more time than I do. Don't just toss this aside as entertainment. Take some action, even if it's just to go back to my website and review the stuff that's on there. But I really encourage you to, if you've made it this far, then you're really going to get a lot out of the 2-day class with Eddie. So I encourage you to do that. So anyway, I hope you've appreciated the presentation. So congratulations, you've made it to the final slide, number 169, just for part 2. But if you made it this far, I can't stress enough the value that you will receive with this basic information that I've taught you and taking it to the next level with Eddie. So please make sure you visit that site, go through, look at all the value that they're going to deliver. It's an experience. It's an incredible experience. I love showing up when I get the opportunity when it's here in Dallas to get caught up and to interact with everybody again. So please take the time to at least look through that. There's my contact information. Hope you found this valuable, and hopefully this has kickstarted your journey on the way to financial freedom like it has done for me. I wish you all the best. Hope to see you in the Note community, and you all take care.